Let me now bring on board S. Naren, Chief Investment Officer with ICICI Prudential AMC. Naren, good to have you back. Thank you for joining us. Narendra, how would you sketch the big picture for us? Yes, things optically are looking better. There is some optimistic chatter which is making a comeback, but markets have done precious little.
Why do we believe that? If you see the one-year return in markets, I think it's about 25%. And go back to the same day last year and today, I think markets have done very well actually. No one believed at that point of time that equities would give you this kind of return. At that point of time, no one believed that inflation will come off and gilts and income funds will also deliver very good returns. So I think that is not true. I am of the belief that actually returns have been very good. The only issue is that from here on, where do we go? Because we are in a situation where the Fed appears to be tightening, or they will do this confused speak where they need to tighten, but they don't know how to tighten because the ramifications of tightening are not clear to the global markets. I think that issue we are certainly going to face over the next 1 year. And obviously, we have an important political event, the election also coming up in the next 1 year. And both these events are certainly something which is going to keep the market confused and volatile in the next 1 year. That's what appears to be clear at this point of time.
Narendra, I wouldn't say off-late markets are weak, but off-late markets have been volatile. Do you think the best part of the summer rally is now behind us because in the near term there are no big triggers, markets are completely dependent on global cues, and what Fed will do, what BOJ will communicate, those events will have an impact on liquidity, and in turn it will have an impact on Indian equities?
Actually, markets first are volatile. The second is that we have a wide gulf. I think Adrian Mouat of JP Morgan coined a term recently called growth at unlimited price, gulf as he calls it. That seems to be totally in operation in India. You have a set of stocks which are all with price to earnings trading P's of about 30, which keep going up every day. And on the other hand, you have a set of stocks which have dividend yields which are more than 4% trading at all single digit P's. Those stocks keep going down every day. So I think the market, very difficult to say what the market will do. It's very clear that I've had this view now for almost 6 months and it hasn't worked at all. I think it is impossible for all the 30 to 40 PE trading stocks to keep going up when another set of the market keeps on going down. So I think either there has to be a rebalancing of the price to earnings, or you're going to see a market actually go down, because you can't have this continue endlessly.
Naren, you talked about the market being in a range for all of next year, given the positives and the negatives that would be working towards the market moves. Do you think there is a ceiling that the market has at, say, 6,300 levels, or could it go higher than that in the latter part of this year?
See, the unfortunate thing is that Indian investors are massively underinvested in Indian equities at this point of time. And if the market were to cross 6,300, unfortunately, we believe that the Indian investors will be back because they are massively underinvested. Otherwise, what they have been doing over the last 3 years has been that if the market comes about 20,000, they keep redeeming, and if the market goes down, they invest a fraction of what they redeem. That's what they've been doing. Unfortunately, I would be very worried if in the near term market goes above 6,300, because the locals who have all redeemed, and that too not small sums of money over the last 6 years, they unfortunately may come back violating asset allocation, whereas what we've been telling people to do is invest systematically through this period. But as you know, the industry hasn't got big inflows.
Naren, if I look at your last declared portfolios, at least the big ones, you don't own consumers, you have a little exposure to autos, you have underweight stance on financials as well. Why is that?
See, actually, our belief has been that, dollar is going to be the asset class which is going to do extremely well. And frankly, that part of it has paid out. If you see the way dollar is moved against most currencies. But on the stock side, the sectors which actually gain from a strong dollar haven't done well, with the exception of pharma. And that's the surprising aspect at this point of time, because I think if you see what has happened in the last 6 months, dollar has done very well, US economy has done reasonably well, US markets have been the best performing markets in the world. But the Indian sectors like technology, which are linked to the US economy, have done pretty badly. So that's why some of these things have been surprising, because what essentially has been happening is that people have been investing in the winners. So the price to earnings of the winners keep going up, and my belief is that has never worked. And I've seen it from past cycles like 2000 and 2007, that you can't have a wide intra-sector variation in valuation, and the wide inter-sector variation in valuation doesn't sustain over the long term. And that's a call we've had, as I said, for the more than 6 months now, or more, almost a year now, which has not paid off so far. But we don't believe it works, because the 2000 and 2007 experience is clearly there for you to see. There were fairly large intra-sector variation in valuation, and they got corrected subsequently through the costlier sectors underperforming, and that's our belief.
Naren, but what has worked in the past may not work in the future. That is the basic line of a mutual fund document. So in the past, maybe owning expensive consumer names has not worked. But at a time when global liquidity is only chasing predictable growth and cash flow models, why do you think one should get out of pharma and expensive consumer names?
See, actually you get equally good opportunities. Actually, there are good regulated utilities which are also very steady cash flow generating entities which don't participate at all in rallies. And they are available reasonably cheap. There are many of the public sector units which are extremely cash rich, and their dividend yields have been shooting up actually, and whose models of business are also pretty defensive, that they don't necessarily do badly. And those stocks have also been doing cheap. So why should I at this point of time invest in 35 PE when I get 7-8 PE stocks with 6% dividend yield, which are equally stable as businesses? So that opportunity presents itself. So why should I go in for the 35 trailing PE companies?
Fair point.
Naren, you were just making an interesting point as to how half of the market is really not invested, there is no retail participation, and people are still chasing the outperformers already. Do you think that is going to be a trend for the latter part of the year as well, wherein we are going to see only the outperforming sectors, largely financials and banks, which are going to see a run-up?
See, I think it's very difficult to say, because the experience of 2000 and 2007 showed that the turning point was never clear, and what caused the turning point is known in retrospect. What I can clearly see from the experience of both 2000 and 2007 is that betting on the costlier sectors did not work. So that's very clear for me to see. So I think that is what we believe. So whether this trend continues at this point of time or changes, we don't know. Like, for example, globally there has been a trend where bond yields have been consistently going down for the last 30 years. But clearly that trend seems to have changed. Now, when the trend changes, what is going to happen to the markets is not clear. At least globally, when you go after high dividend yield companies, the dividend yields are far in excess of what you get in fixed income there. In India, you can't, even today, the highest dividend yield company in Nifty would be about 6%, which would be 3% lower than a bank deposit for 1 year maturity. So I think we are not in the global situation, but we are seeing moves in the market which resemble quality moving at any unlimited price, as one of the people pointed out. I think that trend, it's not logical for us as long-term investors to bet on trends which can't sustain. It's much better for us to bet on long-term trends which will sustain. So we will stay with the low PE, high dividend yield under-owned stocks and hope to get returns, because that's what worked for us in the 2007 to 8 phase. And that's how actually value funds became the best performing funds in the last 5 years, because somewhere in 2007 it was very clear that the valuation differentials were very large and they couldn't sustain. But it was the value funds which were well positioned, and again I think we are in that kind of situation today.
Naren, you also have a very large exposure to commodities. Now that's a big contra call. Is that more like a global macro call because you are bullish on global growth, because you're bullish on dollar, you're buying into commodity stocks, or that is more like a value call?
See, it is both a value and dollar call. One of the interesting things is many of the rupee prices of commodities have actually gone up in the last 2 months or so. But the market doesn't look at it. At this point of time, as I mentioned, other than growth at unlimited price, nothing else seems to be working. And consequently, for us to bet against something which looks logical, today to bet that dollar will do well when Fed is possibly on a situation where they'll have to tighten sometime. And growth is the reason for the tightening. Consequently, I don't think you need to worry about rupee prices of commodities. And you're getting them at dirt cheap stocks. You're getting stocks at 4% dividend yield, 5-6 PE. These kind of stocks you're getting in the commodity space. So, and some of them are not leveraged. We're very careful to avoid the over-leveraged companies in our portfolios, because what we believe is while the over-leveraged companies, they will have to do the deleveraging process. That's not going to be easy. But other than that, you have today so many cheap stocks which are cash rich and also cheap. So that kind of opportunity presents itself periodically. And we are using that opportunity. Having said that, has it worked in the last 3 months? The answer is no. Has it worked in the last 6 months? The answer is no. Will it work? Surely, because that's the experience of what we've seen over investing over the long term.
Naren, so what is it that you're advising your clients to do when it comes to mid-caps? How does one approach there? Are there names there, like you just pointed out, wherein valuations are looking cheap and there is significant amount of cash flow as well on the balance sheets?
See, the experience of investing shows that when there are wide inter-sector deviations in valuations like 2000 and 2007, the best funds to invest in are value investing funds. So we've been recommending our funds like Discovery. Of course, value investing is a good long-term tool rather than a short-term tool. We've been recommending those kind of things because they are the best funds to invest in when sectoral deviation in valuations are very large. So that's what we've been recommending. In that fund, we do have mid caps and we do have large caps, because today you have large caps also, some of them trading dirt cheap. So we believe that's the best way to play, because you're getting both the cheap mid caps and the cheap large caps at this point of time. And the flexi cap nature of the mandate allows. Of course, value investing is a long-term tool which has always worked in the long term. In the short run, it has never been sure whether it will work. So that's what we've been actually recommending. More than importantly, where we are having a problem is that investors seem to be very happy doing redemptions at all points of time. The whole logic of asset allocation meant that, you keep people with a certain equity weightage in your portfolio at a particular point of time. And unfortunately in India, what we see is that people don't do it, and as the people have been continuously cutting their equity allocation. What is healthy, what I can tell you as a mutual fund is, we saw that duration funds like the income funds got fantastic money inflow about a year back and thereafter, and that happened in tune with asset allocation, which means that when the asset class had done badly, people went and put money. And they've been very, very benefited by that. And that surprisingly works in fixed income markets. People manage to invest at what I call market bottom, which is when yields were high and income funds had done badly in the past. But in equities, what we find is that trend doesn't seem to happen. I don't know why.
Final question, Naren. Tomorrow Q4 GDP number will be out. Do you think that is unlikely to be a market moving event, because the world knows that Q4 for Indian economy was under stress because of poor government spending?
Yeah, actually, we are not so worried about the Q4 GDP. What worries us at this point of time is we would like to see much lower trade deficits. on a monthly basis, and we were very, very enthused by the March number of trade deficit. Unfortunately, we are not seeing the trend post-March, and actually, if you ask me, if once we feel that the trade deficit comes down to a $12 billion range per month, I think we would be extremely happy, and we won't worry about past data like even like the Q4 GDP number tomorrow. But having said that, I think if the fixed income markets will watch that number and the number comes very low, people will be very happy because there is a possibility of further easing. But to me, and the way Reserve Bank has also very well communicated in the last 6 months, the trade deficit, current account deficit area is much, much more important to us from an easing perspective and from a future perspective than past indicators of growth.
Naren, really good having you on the show. Appreciate you taking the time out and joining us.